Welcome to our comprehensive guide on accounting and taxation for exchange-traded currency derivatives. In this chapter, we'll break down the essential accounting treatments, disclosure requirements, and taxation rules you need to know. Whether you're a finance professional, a business owner, or just curious about how derivatives are handled in financial statements and tax filings, this video will provide a clear and structured overview. We'll start by exploring the relevant accounting guidelines, move into disclosure requirements, and then cover the key aspects of taxation, including how profits and losses are treated. Let's dive in and make these complex topics simple and approachable. Accounting for exchange-traded currency derivatives follow standards similar to other exchange-traded derivatives. The accounting, valuation, and capital requirements are governed by the applicable accounting standards and valuation methods prescribed by the Institute of Chartered Accountants of India, ICAI, or other relevant standard-setting organizations. Regulators may also specify additional requirements for participants. This ensures consistency and transparency in how derivatives are reported in financial statements. By adhering to these standards, entities can provide stakeholders with a clear picture of their financial positions and risk exposures. ICAI has issued detailed guidance notes on accounting for derivatives contracts, most recently revised in 2021. These notes specify that entities such as banks, non-banking finance companies, housing finance companies, and insurance entities must follow the accounting treatments prescribed by their respective regulators. If no specific guidance exists, the ICAI recommendations should be followed. The guidance ensures that all derivative contracts are recognized on the balance sheet and measured at fair value, reflecting the true economic impact of these financial instruments. Core principles outlined by the ICAI for accounting derivatives include recognizing all derivative contracts on the balance sheet at fair value. If hedge accounting is not used, changes in fair value are recognized in the profit and loss statement. If hedge accounting is applied, the entity must clearly document its risk management objectives, the risks being hedged, and the methods for measuring effectiveness. Adequate disclosures about accounting policies and hedging activities are also required in the financial statements. All derivatives must be recognized on the balance sheet at fair value. Fair value represents the price that would be paid to transfer a liability or receive to transfer an asset to a knowledgeable, willing counterparty. This value should also consider credit risk and the availability of collateral. By measuring derivatives at fair value, financial statements provide a more accurate and up-to-date view of an entity's financial position and risk exposure. Hedge accounting allows entities to match the accounting for derivatives with the risk management objectives they serve. While it's not mandatory, if an entity chooses to designate a derivative as a hedging instrument, it must identify the risk being hedged, demonstrate how the derivative meets this objective, and document the process thoroughly. This approach helps reduce volatility in profit and loss statements by aligning the timing of gains and losses on both the hedged item and the hedging instrument. Apply hedge accounting. An entity must clearly identify its risk management objective, show how the derivative contract helps achieve this, and specify how the fair value of the instrument will be measured. Documentation is required at the inception of the hedge and at every reporting period. For cash flow hedges, it's also necessary to demonstrate that the forecasted cash flows are highly probable. These steps ensure that hedge accounting is applied consistently and transparently. There are three main types of hedge accounting recognized by the ICAI guidance: fair value hedge, cash flow hedge, and hedge of a net investment in a foreign operation. Each type addresses different risk exposures and has specific requirements for documentation and measurement. Understanding these types helps entities choose the most appropriate method for their risk management strategies. Fair value hedge is used to offset the risk of changes in the fair value of an existing asset or liability, or an unrecognized firm commitment. For example, a company might use an interest rate swap to hedge the fixed interest payments on a bond, converting them to floating rates. Gains or losses from both the hedged item and the hedging instrument are recognized in the profit and loss statement, providing a balanced view of the risk and its mitigation. Cash flow hedge is designed to manage the risk of variability in future cash flows related to an asset, liability, or a highly probable forecast transaction. Under this model, the effective portion of gains or losses on the hedging instrument is recognized in equity, typically in a cash flow hedge reserve. This approach helps avoid unnecessary volatility in profit and loss statements, especially when the timing of gains and losses on the hedged item and the hedging instrument do not match. Net investment hedge is used by investors in foreign operations to manage the risk of changes in the carrying amount of net assets due to currency translation. Gains and losses from both the net investment and the hedging instruments are recognized directly in equity, with any ineffective portion recognized in profit and loss. Upon disposal of the foreign operation, deferred gains and losses are recognized in the profit and loss statement. Derivative assets and liabilities recognized at fair value should be presented as current or non-current based on their intended use and settlement dates. Trading derivatives are classified as current, while hedges of recognized assets or liabilities follow the classification of the hedged item. For derivatives hedging forecasted transactions, classification depends on the settlement or maturity dates. This approach ensures clarity and consistency in financial reporting. ICAI guidance does not permit netting of derivative assets and liabilities, except in specific cases under cash flow hedges. All amounts in the financial statements should be presented on a gross basis, providing a transparent view of the entity's exposures. However, for derivatives not designated as hedges, gains and losses may be presented on a net basis in the profit and loss statement. Entities must provide comprehensive disclosures about their financial risk management objectives, the nature and extent of risks, and the methodologies used to determine fair value. Disclosures should also include details of outstanding hedge accounting relationships and the impact of derivatives on financial statements. This transparency helps users understand the entity's risk profile and how it manages those risks. Hedge effectiveness measures how well changes in the fair value or cash flows of the hedged item are offset by the hedging instrument. The ICAI guidance does not prescribe a single method for testing effectiveness. Entities can use methods like critical terms match, dollar offset, or regression analysis, depending on their specific risk management objectives. This flexibility allows each entity to choose the most appropriate approach for its circumstances. Accounting Standard AS-30 issued by the ICAI sets out the principles for recognizing and measuring financial assets, liabilities, and certain contracts. AS-30 defines derivatives as financial instruments whose value changes in response to market variables, require little or no initial investment, and are settled at a future date. These criteria make AS-30 applicable to exchange-traded derivatives contracts. According to AS-30, a derivative is a financial instrument or contract that meets three criteria. Its value changes in response to market variables, it requires no or minimal initial investment, and it is settled at a future date. These features distinguish derivatives from other financial instruments and ensure they are accounted for appropriately under AS-30. AS-30 applies to exchange-traded derivatives because these contracts meet the standards criteria. Participants in the market should refer to AS-30 and similar Indian accounting standards for detailed guidance on recognizing and measuring derivatives. This ensures consistency and compliance with regulatory expectations. Now let's shift our focus to the taxation of exchange-traded currency derivatives. Gains or losses from trading these derivatives are taxed under the head Profits and Gains from Business or Profession, PGBP. Administrative expenses related to trading are deductible. The Income Tax Act classifies business income as either speculative or non-speculative, with different rules for each. Understanding these distinctions is crucial for accurate tax reporting. Income from speculative transactions is treated differently from non-speculative business income. A transaction is considered speculative if it is settled otherwise than by actual delivery or transfer. However, certain derivative transactions used for hedging are specifically excluded from the definition of speculative transactions. This means that income or loss from exchange-traded currency derivatives is generally treated as normal business income, even if no delivery occurs. For foreign portfolio investors, FPIs, securities are always treated as capital assets. As a result, any profits or gains from derivative transactions are taxed under the head capital gains. If the derivatives are held for less than 12 months, gains or losses are classified as short-term capital gains or losses. This distinction is important for FPIs when planning their tax strategy. Income Tax Act does not specify how to compute turnover for exchange-traded derivatives. However, the ICAI's guidance note on tax audit provides a method. Turnover is the total of favorable and unfavorable differences, plus any premium received on sale of options, and differences from reverse trades. Accurate turnover calculation is crucial for determining tax audit requirements and eligibility for presumptive taxation scheme. Calculating turnover correctly is vital because it determines whether a tax audit is required, and if the taxpayer can opt for the presumptive taxation scheme under Section 44 AD. If turnover exceeds the specified limits, a tax audit becomes mandatory. The Union budget for FY 2024-25 has increased the turnover limit to Rs. 3 crore, provided 95% of receipts are through online modes. This change aims to encourage digital transactions and simplify compliance. Under Section 44 AD, eligible taxpayers can opt for the presumptive taxation scheme if their turnover does not exceed Rs. 2 crore, now Rs. 3 crore with 95% digital receipts. Profits are declared at 6% of turnover for digital receipts or 8% for cash receipts. This scheme simplifies tax compliance by eliminating the need to maintain detailed books of accounts and allows for a single advance tax payment by March 15 of the financial year. Alternatively, income from exchange-traded derivatives can be taxed under the normal scheme. Here, all business expenses are allowed as deductions, and the taxpayer must maintain prescribed books of accounts. The normal scheme is suitable for those with higher turnover or more complex financial situations, ensuring all income and expenses are accurately reported and taxed at applicable rates. For those opting for the presumptive taxation scheme, advance tax can be paid in a single installment by March 15. This simplifies the tax payment process and reduces administrative burden. For others, advance tax must be paid in installments as per the regular schedule. Timely payment of advance tax helps avoid interest and penalties. Losses from trading exchange-traded derivatives, if treated as normal business losses, can be set off against income from other heads except salary. Unabsorbed losses can be carried forward for up to 8 assessment years and set off against future business income. However, to retain this right, the tax return must be filed on or before the due date. Late filing results in the loss of carry-forward benefits. If a transaction is classified as speculative, losses can only be set off against speculative income. This restriction does not apply to exchange-traded currency derivatives, which are generally treated as non-speculative. Understanding this distinction is important for accurate tax planning and compliance. To carry forward business losses, it's crucial to file your income tax return by the prescribed due date. Missing the deadline means losing the right to carry forward and set off losses in future years. This rule emphasizes the importance of timely tax compliance for traders and investors in exchange-traded derivatives. Let's recap the main points. Accounting for exchange-traded currency derivatives follows strict standards set by ICAI and regulators. All derivatives are recognized at fair value with detailed disclosures required. Taxation treats most derivative income as normal business income with special rules for FPIs. Turnover calculation is crucial for audit and tax scheme eligibility, and timely filing ensures you can carry forward losses. These rules help maintain transparency and compliance in financial reporting and taxation. Imagine a company holds a fixed-rate bond and is concerned about interest rate fluctuations. By entering into an interest rate swap, the company can hedge this risk, converting fixed payments to floating. If hedge accounting is applied, both the bond and the swap are recognized at fair value, and gains or losses are matched in the profit and loss statement. This example illustrates how hedge accounting aligns financial reporting with risk management strategies. Suppose a company expects to make a large foreign currency payment in the future. To hedge the risk of currency fluctuations, it enters into a forward contract. Under cash flow hedge accounting, effective gains or losses on the forward contract are recognized in equity until the payment occurs, reducing volatility in the profit and loss statement. This approach provides stability in financial reporting. Consider an investor with a subsidiary in another country. The investor uses a derivative to hedge the risk of currency translation on the net investment. Gains and losses from both the investment and the derivative are recognized in equity, and any remaining amounts are recognized in profit and loss upon disposal of the foreign operation. This strategy helps manage foreign exchange risk in consolidated financial statement. Companies' financial statements should include disclosures about its risk management objectives, the types of derivatives used, and the methods for measuring fair value. For example, if a company uses currency futures to hedge foreign exchange risk, it must disclose the notional amounts, fair values, and the impact on profit and loss and equity. These disclosures provide transparency for investors and regulators. Say a trader has several derivative trades with both profits and losses. To compute turnover, the trader adds up all favorable and unfavorable differences, includes any premiums received from selling options, and accounts for differences from reverse trades. This total determines whether a tax audit is required and if the presumptive taxation scheme can be used. If a trader's turnover from exchange-traded derivatives exceeds Rs. 2 crore or Rs. 3 crore with 95% digital receipts, a tax audit is mandatory. This audit ensures that all income, expenses, and compliance requirements are met. Staying below the threshold allows for simpler compliance under the presumptive taxation scheme. Taxpayer using the presumptive scheme can pay the entire advance tax in one installment by March 15. For example, if the computed presumptive income is Rs. 6 lakh, the taxpayer pays the applicable tax by the deadline, avoiding the need for quarterly payments. This streamlined process is a major benefit of the presumptive scheme. Suppose a trader incurs a loss from exchange-traded derivatives. This loss can be set off against other business income, such as profits from trading goods or services, but not against salary income. If the loss is not fully absorbed, it can be carried forward for up to 8 years and set off against future business income, provided the return is filed on time. If a loss arises from a speculative transaction, such as a trade settled without actual delivery, it can only be set off against speculative income. However, exchange-traded currency derivatives are generally not considered speculative, so losses can be set off more broadly. This distinction helps traders maximize their tax benefits. Missing the income tax return deadline means losing the right to carry forward business losses. This can have significant financial implications for traders and investors, as future profits cannot be offset by past losses. Always ensure timely filing to preserve your tax benefits and maintain compliance. Summarize: accounting and taxation for exchange-traded currency derivatives require careful attention to standards, disclosures, and compliance deadlines. Recognize all derivatives at fair value, provide transparent disclosures, and understand the tax treatment for your specific situation. Proper turnover calculation and timely filing are essential for maximizing tax benefits and avoiding penalties. Stay updated with the latest accounting standards and tax regulations. Maintain thorough documentation of all derivative transactions, risk management strategies, and disclosures. Use reliable methods for measuring fair value and hedge effectiveness. Consult with professionals when needed to ensure full compliance and optimize your financial outcomes. Avoid common pitfalls such as failing to recognize derivatives at fair value, inadequate disclosures, incorrect turnover calculation, and missing tax filing deadlines. These mistakes can lead to compliance issues, penalties, and lost tax benefits. Regular reviews and audits can help identify and correct errors early. For more detailed information, refer to the ICAI Guidance Notes, Accounting Standard As 30, and the Income Tax Act. These resources provide comprehensive guidance on accounting and taxation for derivatives. Staying informed will help you navigate the complexities of financial reporting and tax compliance with confidence. Conclusion: mastering the accounting and taxation of exchange-traded currency derivatives is essential for accurate financial reporting and effective tax planning. By following the prescribed standards, making thorough disclosures, and staying compliant with tax rules, you can ensure transparency and optimize your financial outcomes. Thanks for joining us on this journey through accounting and taxation essentials.